Unmute. Thank you.
What happens when a bank stops thinking like a bank? Instead of keeping the status quo, it challenges it. Instead of thinking about how people should bank, we should think about how we can improve their lives. Instead of just offering products and services, we create experiences. When a bank stops thinking like a bank, it changes the game. This is what we're doing. We're bringing the future of banking to the present by being forward-thinking, innovative, agile, and open. The future is not an upgrade of the present. It's about doing things in an entirely different way. It's not just about creating products and services, but about bringing the bank to our clients wherever they go. The future is about embedding banking into everyone's lives. To accelerate your growth, we are connecting you to a whole new world of opportunities. To drive you to success, we're powering the future with advanced technology and platforms. So forget what you know about banking. This is our revolution. We are transforming every transaction and interaction because we don't want to interrupt your life. We want you to enjoy it. We don't want to just support your business. We want to help you build it. The future is here now, and we are just beginning. We are going to transform the lives of all Filipinos. We are a company of future-forward thinkers, committed to bringing dreams to life. And our focus is entirely on you. Because at Union Bank, the future begins with you.
Really no sound. Are you guys hearing it? It's really quiet.
From my end, there's sound, Ed. We're good.
Okay, from my end, I don't hear anything except when you
make you smile. Kaya
I
when
don't
it's
know
time
if the
to eat,
other panelists can
laging
hear
special.
me.
San
We'll
Marino
check.
corn tuna.
Thank you,
Punong-puno
President.
ng
Thank you.
flavorful tuna that's rich in omega-3. Lasa pang sarap in every bite.
I'm glad I get to celebrate each day with you. Pasarapin ang love.
With San Marino.
log out and come back in. Just a few seconds.
Welcome back to New Day.
We've got all the news you need and more.
We still have here with us members of the national women's football team who just won the title at the AFF Women's Championship.
Dadalo si President-elect Bongbong Marcos sa Asia-Pacific Economic Cooperation o APEC Summit sa Thailand.
Ngayong No Smoking Awareness Month, alamin natin kung paano tuluyang magkukwit.
A South Commuter Railway linking Metro Manila and Laguna goes full steam ahead.
Nakipagpulong ang Pangulo kay Indonesian President Joko Widodo at tinalakay nila ang iba't ibang hamong kinakarap ng ASEAN dahil sa pandemya. Itutuloy na ng Cebu City ang pagluluwag ng pagsuot ng face mask pero ayon kay Mayor Mike Rama, ito ay trial period pa lamang.
President Ferdinand Marcos Jr. brings home over 800 billion pesos worth of investment pledges from his state visits to Indonesia and Singapore.
Humingi na ng saklolo ang grupo ng mga panadero. Apektado na rin daw ang kanilang industriya.
Ayon sa Labor Department, inaprubahan na ng National Wages Productivity Commission ang 50 pesos na dagdag sahod.
Not all information are created equal. With an abundance of sources on different platforms, experience is essential. Excellence counts. Integrity matters. Because decisions and strategies are only as good as the information you base them on. For the past 35 years, Business World has been at the forefront of business news, helping shape our country's development through the leaders and people of influence who count on the paper as their primary news source. The information delivered through the pages of Business World enable decision makers to achieve important milestones as they rise and thrive even in challenging times. As business world evolves with its audience, it has brought its legacy of reliable and credible journalism to new media to deliver more beneficial services to a growing audience. Business World is committed to having its valuable and compelling content flow seamlessly from the paper to digital, social, mobile, video, and TV to reach the people where they are. With the Philippine business landscape in a state of constant transformation, Business World will continue to evolve with the needs of its market. Despite the changes, some things will never change. Excellence anchored in untarnished integrity, now and always.
Sign up for a year and pay less than 71 pesos per month. Visit tmt.ph/digital to get your free 30 days of the Manila Times Digital Edition.
This year's FINEX annual conference would not have been possible if not with the support from our sponsors and partners. We would like to thank our sponsors. Platinum sponsors, KPMG RG Manabar & Company and Union Bank of the Philippines. Diamond sponsors, Megaworld, Noasis Corporation, CDO Foodsphere Inc., and Vista Land. Gold sponsors, All Home, Ayala Land Inc., Deloitte, Institute of Management Accountants, Robinson's Land Corporation, Philippine Shell Petroleum Corporation, SGV & Company, and Smart Communications. Patron sponsors, BDO Unibank Inc., PNA Grant Thornton, RCBC, FTI Consulting, San Miguel Corporation, and St. Peter Life Plan. Minor sponsors, McDonald's and Wilkin Depot. We would like to thank our official broadcast partners, ANC and CNN Philippines, and our media partners, Business Mirror, Business World, Manila Bulletin, Philippine Star, and the Manila Times.
Good day. Welcome to the second day of FINEX Annual Conference. Is your company ready? Global investment opportunities and risks. This session is presented by the FINEX Week Committee in cooperation with the Professional Development Committee. Let us all give a warm welcome to our host. He is the Liaison Director of Professional Development Committee, Mr. Ronald Goseco.
Hi, good morning everyone and welcome to the second day of the 54th FINEX Annual Conference. Our theme for today is Global Investment Opportunities and Risks. I'm Ned Goseco, your host for today. Thank you all for joining us. The 2022 version of the Global Risk Report, published by the World Economic Forum, which, as we all know, is the preeminent organization tackling the latest trends and issues covering the world economy, is a must-read for all of us business people. It was written in 2022, actually I think it was late 2021, in partnership with Marsh McLennan, SK Group, and the Zurich Insurance Group. We are privileged to listen to Marsh in our session this morning. In addition, we will have one of our keynote speakers, Blackstone, the leading global investment business, which invests capital on behalf of pension funds, large institutions, and individuals. To achieve the phenomenal returns they've been giving their clients, they have an excellent understanding of the global investment opportunities and risks. We look forward to hearing from them later. And now, to formally open the program, may I call on our President, Mr. Michael Arcotomy Gorin, for his welcome remarks.
Thank you, Ned. Good morning. A blessed good morning to everyone. And again, welcome to our 54th FINEX Annual Conference, Reshaping the Future with Transformational Change. And as you know, and as mentioned by Ned, we are on our second session. Is your company ready? Understand global investment opportunities and risks. Whereas our discussions yesterday revolved around a micro topic, the transformative power of finance in life and business, it was more personal as it revolved around personal investments, saving. Although our topic this morning will still cover investments, it will be more from a macro perspective, as we will discuss the trends of global investments on one hand, and then on the other, global risks. Who best to discuss these global themes than some of the largest firms in their respective fields? I'm looking forward to hearing from our second speaker, Mr. Amit Dalmia. He is a Senior Managing Director of Blackstone. As you know, it is a listed entity with over $100 billion in market capitalization, and it is one of the largest alternative asset management firms in the world with AUM, or assets under management, of around $1 trillion. If there is a company with a global print in the world, Blackstone is definitely one of them. And I'm equally excited to hear from our first speaker, Mr. Graeme Riddell. He is the Vice President at Marsh McLennan, handling climate and sustainability. A quick background. We are all very familiar with the World Economic Forum, and it was touched on by Ned earlier. And it's normally held at the start of each year at Davos, Switzerland. Every year, they release a report entitled the Global Risks Report. And Marsh is one of their partners. And it's a very short list of partners when it comes to writing the report. So I feel equally privileged to be hearing from Graeme shortly. I hope that after listening to our speakers, we will have a better appreciation of global investment trends and the global risks that are normally associated with them. I would also like to thank FINEX past president and BDO Capital President Ed Francisco for agreeing to take part in the panel discussion that will follow our two keynote speakers. PP Ed, we always value your views. Thank you for gracing us with your presence as well. So thank you again to the PDC, or the Professional Development Committee, for helping put this session together. To their liaison director, / our MC this morning, Ned, thank you. And co-chairs, Paul San Pedro and Edith Estacio. And then before I conclude this short opening remarks, again, I would like to express my sincerest thanks and appreciation to our corporate sponsors. As mentioned, platinum sponsors, KPMG, RG Manabat and Company, and Union Bank. Diamond sponsors, MegaWorld, CDO Foodsphere, NOAA Business Applications, Vistaland. Gold sponsors, All Home, Ayala Land Inc., Deloitte, the Institute of Management Accountants, Robinson's Land Corp., SGV and Company, Pilipinas Shell, Smart Communications. To our patron sponsors, BDO, FTI Consulting, PNA, Grant Thornton, San Miguel Corporation, RCBC, and St. Peter. Minor sponsors, McDonald's and Wilton Depot, and also to our official broadcast partners, ANC and CNN, and to our media partners, Business Mirror, Business World, Manila Bulletin, Philippine Star, and the Manila Times. Again, maraming salamat. And without further delay, I would like to hand the virtual floor back to our MC, Ned. Again, enjoy the session, everyone, and mabuhay ang FINEX.
Thank you, President Mike. To lead off the celebration of the 54th FINEX Annual Conference, let me call on the co-chair of the FINEX Week Committee, Ms. Maria Mignon Ramos, for her message. Migs?
Good morning, everyone, and welcome to the second session of the FINEX Annual Conference. We're very grateful for your attendance. Together with the Professional Development Committee, it's Liaison Director Ned Goseco and co-chairs Edith Estacio and Paul San Pedro. The FINEX Week Committee, with our Liaison Director Gemma Cheng, and my co-chair Renan Piamonte, we would like to thank those who supported us by inviting even our guest speakers and panel today, no? So including Ms. Larry Concepcion of Marsh and Attorney Yuni Mata Perez. So thank you to them for their support. And because we're very, very grateful for our sponsors, we'd like to formally thank again the Platinum sponsors, KPMG, RG Manapat and Company, Union Bank, our Diamond sponsors, Mega World, NOAA Business Solutions, CDO Foods Fair, Vista Land, our Gold sponsors, All Home, Ayala Land, Deloitte, the Institute of Management Accountants, Robinson's Land Corporation, SGV and Company, Pilipinas, Shell Petroleum Corporation, Smart Communications. Our patron sponsors, BDO Unibank, PNA Grant Thornton, RCBC, FTI Consulting, San Miguel Corporation, and St. Peter Life Plans. Our minor sponsors, McDonald's and Wilcon Depot, and our official business broadcast partners, ANC and CNN, and our media partners, the Business Mirror, Business World, the Manila Bulletin, the Philippine Star, and the Manila Times. All of these would not have been possible nor considered even successful without your support and without your attending our session today. So thank you to all of you who are here today with us, our 176 strong number of attendees. Thank you.
Thank you, Migs. Thanks again, Migs. To all of our Zoom participants and viewers from our live stream, we're thrilled to have all of you join us today. Just like you, I look forward to today's discussion. Let's all jump into it now. May I now introduce our first speaker, Dr. Graeme Riddell, is a climate and sustainability consulting leader of Marsh Asia. Graeme leads climate and sustainability consulting across Asia within Marsh Advisory. In this role, he supports clients analyze and prepare for the risks emerging from their sustainability transformation and create more resilient assets, value chains, and strategies. He has delivered ESG and climate-related risk projects across the region and a range of industries. Before joining Marsh Advisory, he led research into climate-related and emerging risks for the parent company, Marsh McLennan, and managed relationships with high-level organizations, including the WEF on global risk issues, and was an author of the Global Risk Report. Graeme was also a climate risk and resilience consultant with the World Bank, supporting the integration of climate change into risk management strategies. He has held a range of academic positions and consulted to public and private entities on ESG and climate risk across Asia Pacific, including financial services, power utilities, and logistics companies. He graduated with a degree of Bachelor of Engineering, Civil and Environmental First-Class Honors from the University of Adelaide and earned his doctorate in Environmental Engineering and Risk Management from the University of Adelaide as well. Ladies and gentlemen, let us all welcome on the virtual floor, Dr. Graeme Riddell. Graeme, the floor is yours.
Thank you, Ned, and thank you everybody for joining us this morning, and thank you so much to FINEX for the invitation to speak today as well. Let me share my screen. How is that? Does everything look okay?
Yes,
all
it does.
good, Graeme.
Perfect. So thank you so much for that introduction, and excellent to be with you this morning. So yes, I'm going to be sharing some insights today from the Global Risk Report, but I will qualify this that the report was launched way back in January and February this year, and the world has changed a lot. It was published pre Russia and Ukraine. And then even if we fast forward again, there's a lot of things that have happened, but I think it really speaks to how volatile our risk landscape is, and really more around the topic of today's discussion, which is how companies can prepare for these types of risks, regardless of what the risks may be. By way of introduction, I've been introduced as coming from Marsh. So Marsh sits within Marsh McLennan, which is the world's leading professional services firm in relation to risk strategy and people. And we pull together 4 businesses: Marsh, which is the insurance broker and risk advisor, which many of you will likely do business with. We also have Guy Carpenter, who is a reinsurance broker, Oliver Wyman, which is a management consultancy, and Mercer, which is our people and investment business. And today we're really talking about the Global Risk Report and resilience and risk management in general, I think, and how this feeds into investment decisions and opportunities. And the Global Risk Report itself is in its 17th year of publication, and Marsh McLennan is very proud to have been its partner since the very first one. And the report provides a rich perspective on major risks to global prosperity, including economic, geopolitical, societal, technological, and environmental risks. And what I think is quite unique about this report versus a lot of the publications that come out is its focus on the long term. It's always grounded itself in the risks over a 10-year, over a decadal timeframe, not just what's next. And I think it's really a powerful piece of insight as you're planning for those strategic and long-term decisions to understand, what could be on the landscape. And the report itself is derived from surveys from experts and business leaders, and exploration by the WEFTS network. And one of its core information sources is what we call the Global Risk Perception Survey. And in the 2022 version of the report, there were over 950 responses to the survey, which covers risk experts from across business, government, NGOs, international organizations, and academia globally. And the GRPS covers questions on the global outlook for 2022. What are the kind of leading concerns over a 10-year horizon? So 10 years out from 2022. What are some of the key risk drivers across different time horizons, short, medium, long term? And the risks and the blind spots that might currently exist in the global response to macro level risks. And I've pulled out one of the results on the screen here today, which is looking at the next 3 years. So we've only got 2 more years to run of this. But I think it's quite telling that the predominant focus of the results was quite a negative scenario. So most respondents thought the world was going to a negative place, which I think, on reflection 1 year into the 3 is probably fair. But I think that almost 42% saying consistently volatile with multiple surprises, I think we could all probably resonate with that. I don't think sitting in January or February, you would have quite predicted exactly what's played out in the combination of pandemic and resurgence and those types of things with COVID, plus global conflict, plus, oil and energy crises, plus, the inflation and the interest rate environment that we currently find ourselves in right now. So we can't pick everything, but what we can do is be prepared for volatility and be prepared for multiple different surprises. And it's really up to, decision makers in business to be prepared for the range of uncertainty more than just trying to decide what's going to be the one risk that you're going to focus on and try to manage. And the central theme of the Global Risk Report was worlds apart. And the report really at its core tried to capture how global divergence was happening across multiple domains, kind of post-COVID, and how the recovery from COVID would threaten to widen disparities and aggregate social fractures. So the report examined societal and economic fallout from COVID, and the disparities that persisted in year 2, and its ability to kind of compound social fractures and geopolitical tensions. And against that kind of backdrop, that introductory section, there were 4 deep dives in the report, which looked at disorderly climate transition. So how do we move towards net zero, and what are the transition risks that fall out from that? a growing digital dependency. I think we all became, hyper digital dependent during COVID, which was essential to kind of navigating the risk landscape. But that creates risks moving forward, and it also, has the potential to leave people behind who weren't connected to technology. The implications to migration and how the fallout from that has happened post-COVID, and a little bit left of center maybe, but as I said, the report has always tried to kind of push the envelope in terms of the risk landscape, was accelerating space ambitions and what can happen in the kind of space landscape and what risks emerge there as geopolitical powers start using that as a domain to intersect. The report then has a reflection on year 2 of the pandemic and some of the lessons learned on preparedness and resilience, and some of the key cross-cutting issues that kind of fell out in every single chapter were around socioeconomic disparity and geopolitical splintering, and I don't think that's changed at all in the last 8 months since it's been published. And then risk independencies, how everything is interconnected, and we can't just I would say take a simplistic view of risk and try to fit it into a perfect risk register that sits nicely in our Excel spreadsheets. And shortfalls in global governance, and I think we've seen that quite a lot in terms of some of the lackings in our global governance systems and how they may struggle to keep up to date with the modern issues and what global powers are willing to do these days. So we're going to focus a little bit on the first two, so navigating the climate transition and protecting digital developments. So when we speak of the climate transition, I think there's an overarching ambition has been set there, and governments have signed up to it of our move towards net zero. But I think there's mounting conviction that, a fast climate transition is being slowed by social, political, and economic complexities. It's hard. And the risks are being created of moving towards a net zero trajectory, and all these risks are emerging at different speeds with different degrees of complexity. And that comes from access to capital, access to insurance, new technology, the ability to pay for these new technologies, willingness to pay, and all of these types of things. So, the report kind of pulls out, and we do kind of see it happening with some rapid shifts in the global landscape, that a disorderly climate transition with divergent approaches has the ability to trigger economic volatility, probably hasten the adoption of risky and untested technologies, which we just don't understand yet, and further drive apart countries and bifurcate societies. And I think this disorderly transition we're starting to see play out a little bit as different countries move at different speeds. So rapid shifts away from really carbon intense industries, which currently employ millions of workers. The report foresees that it could trigger economic volatility, deepen unemployment, and increase societal and geopolitical tensions. Additional to that is the adoption of kind of hasty environmental policies and the potential for unintended consequences. There are lots of, still major unknown risks from deploying, untested biotechnology, untested geoengineering technologies that we just don't understand yet, coming from the insurance world, coming from the risk and insurance world. We're very cautious about these types of things, and we need to understand the risks associated with it before we pour billions of dollars of capital in certain directions. And fundamentally, when we talk about societal and geopolitical tensions, it's going to come down to unequal access. So unequal access to materials and funds means that the transition is going to increase tensions across different groups, and we could see a lot of unintended consequences from that as well, as different groups move quite quickly in different directions. Going now into the digital dependencies, and I think technology is such an enabler, but so many risks associated with it as well. So converging technological platforms, tools, and interfaces connected via internet is, we're moving towards this version 3.0 of the web, and we're simultaneously creating a far more complex cyber risk landscape. And there's a growing number of critical failure points as more and more of our kind of core infrastructure is dependent on digital systems. We see, massively changing risk landscapes in terms of cyber threats, and a far more aggressive cyber risk landscape as well, with party states, state parties and non-state parties really going quite aggressive on some of the cyber risk fronts. So attacks on large and strategic systems could carry kind of cascading physical consequences across society. We've seen some major events recently in the telecommunications and utility space. And as these kind of events continue to accelerate, I think some of the intangible risks, disinformation, fraud, lack of digital safety, will also kind of compound and lead to a loss of trust, a loss of public trust in digital systems. And if we take some really kind of simple views on this, so the cyber insurance pricing has jumped massively. In the US, it went up 100% in 1 quarter. And that's the kind of biggest jump since 2015. Cyber attacks on critical infrastructure systems, power, utilities, telecommunications, all of these types of things have accelerated significantly. And digital safety, I think, is under threat. We've got more unexperienced and more vulnerable populations coming online, while the threat of deep fakes and deep information and disinformation and fraud is growing increasingly prevalent. And there's that, source of deep public untrust that could emerge from that. So I just want to spend a little bit, I was introduced as the climate and sustainability leader. So I just want to touch a little bit quite briefly on ESG and climate risks at the global landscape level and what we're kind of seeing. So two things that we're seeing in the insurance markets right now is, a fast tracking in terms of concern around liability risks, and the insurance world trying to figure out how it moves towards net zero underwriting. And on the liability side, we've typically always said that, maybe we won't see it so much in Asia. It's a Europe problem. It's a US problem with their legal systems. We've started to see in both the Philippines and Indonesia court cases and human rights commissions and things like that starting to make inroads in terms of liability and the human rights elements of access to a safe environment. On the net zero underwriting, insurers are trying to figure out what this means. We've got kind of processes around net zero investment and net zero at a corporation. At an underwriting level, it's really challenging, and the insurers are trying to figure out how to calculate it themselves. But in the meantime, they're taking quite an exclusionary approach to some particularly hard to abate sectors. And that's challenging for this part of the world. And I would say in particular, the Philippines, as we move towards a net zero world. And kind of double clicking a little bit on this liability point, there is a growing push towards disclosure, and the Philippines has kind of led the way in the region, to be honest, as well. I think the Philippines is quite good sustainability reporting requirements, and we expect to see, or we are pretty much about to see, a focus on climate related reporting as well with TCFD and what the SEC is saying. The financial institutions are already subject to it. But this creates new risks. So there is a need for companies to make sure their statements going publicly in terms of ESG and climate change are accurate, fact-driven. And I think there's going to be an increasing focus on audit and assurance of these types of things. And one of the reasons why I think this is happening is what I say an expectation gap. So this is some data we have from a survey from Mercer, which showed that 83% of boards are really focused on delivering on ESG and climate change and their sustainability commitments. I'm not sure what the other 17% of board members are doing, but 83% say they're fully committed to ESG. But at the bottom, we can see that only 1 in 4 executives thinks their company has actually made inroads in terms of their sustainability path. And I don't think if you opened up anybody's sustainability report, you would think that only 1 in 4 executives believe that they've made inroads. And that disconnect between, what's being reported, what boards are focusing on, and what executives think they're actually able to deliver on is where we're going to see some of these risks emerge. And liability is going to be the way that companies probably most immediately feel the pain. The other thing that we're seeing kind of rapidly escalate across the region is physical risks and extreme weather and what we consider to be secondary perils. So in the Philippines, we have primary perils. That's what drives the losses, which is earthquakes and typhoons. What we're seeing globally and in Southeast Asia as well is secondary perils. So just flooding, wildfire, landslides, all of these harder to model and less kind of systemically critical perils are becoming the ones that drive the risk for insurers now. And the insurers are reacting and starting to model this themselves. And if we look at 2021, it was just a year of flooding. So we're seeing a lot more flooding because of a lot more rain. And we're also seeing a lot more people live in floodplains and be exposed to this type of threat, which is more exposure, greater dependency on insurance, greater dependency on government ability to respond and recover and help citizens. And we don't foresee this changing. What we do see is the insurers taking away capacity from that cap. And we're expecting next year for there to be a considerable kind of global gap in available capacity for natural catastrophe insurance. Around $20 billion is the last estimate I heard from our colleagues at the Guy Carpenter in terms of how much a gap is existing in the nat cat world next year. So what does this mean for businesses and kind of how you're making decisions and your investments? I think is understanding that yesterday's climate record is just no longer fit for purpose, and integrating kind of a forward-looking view on climate change into where to invest and build, how to operate your assets, how you design your future financial resilience is critical. So if you're making an investment decision right now and you're not building in an ESG due diligence process and you're not building in a climate risk screening, you're going to expose yourself to threats moving forward. And if you're not having conversations with your investment companies and the companies as they're operating their assets in terms of how are their asset management principles changing, you know, if you're a public utility and you're okay with the power going out, you know, 2 times a year, and that's what you have insurance for. But now under certain climate change scenarios, it's happening 10 times a year. Are you still okay to bear that risk? Are you able to transfer that, you know, that risk to the financial markets and the insurance markets? Or do you have to change how you operate your networks? Do you have to upgrade some things? That's the question that I think everybody needs to be going through. And a couple kind of pieces for food for thought in terms of how kind of companies can arrange themselves for these growing volatility and multiple surprises on the horizon. So at its core, I think we need to refresh organizational resilience, and the Global Risk Report touches on this a little bit. And that means a focus on all of our risk assessments, all of our risk analysis isn't there to just sit and look pretty in an Excel spreadsheet. It's to understand how our ability to deliver for our customers, for our clients, for our markets might be impacted, and really taking an ecosystem approach. So not just looking at our own business, looking at our supply chains, looking at our dependencies, utilities, logistics firms, all of these types of things. And we've seen our kind of supply chains be massively put under stress during COVID and simultaneous crises. We need multiple different approaches to risk management and resilience. We can't just put all our money on, you know, one silver bullet for our supply chain management with lots of different systems coming together. I think there needs to be a big focus on people and workforce and, you know, enabling them to make decisions to make your company stronger, and connecting kind of what you're doing at a risk management and resilience level with your core business operations and other goals. So it's not just something that sits alone in a risk management team. It's actually embedded into the ExCo and how companies are thinking about how they operate in the future. How this could look in terms of how we manage supply chains is, you know, from strategic resilience options, there's always this tension between resilience and robustness versus efficiency. So I think we're going to be looking at building more inventory and excess capacity. I think there's a potential to compensate that with achieving efficiencies which you can control. So re-engineering product lines, investing in efficiency improvements in packaging and shipping to kind of compensate the robustness that you might need in your inventory. there's going to be a far greater focus on analytics to enable this, and strategic support for your suppliers. So some of your suppliers might not be big enough to do the analytics themselves. You might need to help them. That will help you in the long term. While this is happening, I think take the opportunity to look at contracting and negotiate with suppliers on how much value they're bringing, and look for options like diversification, dual sourcing, contingent contracting, all of these types of things. And we're seeing a push towards friendshoring. So we've spoken a lot in supply chain before about nearshoring, so bringing things closer to you. In the geopolitical landscape that we're operating in right now, we might be moving towards friendshoring. So having our supply chains located in areas which are friends and will supply us during crisis, and taking greater ownership of everything. While we're going through this refresh of kind of supply chain and resilience and contracting, I think there's an opportunity to apply an ESG lens, which will manage risks into the future as well. So when you're updating your contracting, start having a look at how exposed some of your suppliers are to climate change and extreme weather events. Build in, while you're doing the negotiation, requirements around modern slavery and human rights and equity and diversity. There's an opportunity to do that during the negotiation process and when everything's up for go. So some kind of final takeaways from me in terms of how management can kind of shift towards this, because it is a shift, and we're moving from familiar risks that happen once to emerging risks which happen all the time and intersect with each other and get quite complicated. That means we need to be having these types of conversations all the time and exploring what's happening, so that restless curiosity, and examine different dependencies. When we start thinking about how we respond, we need to start moving away from just trying to respond to everything to how do we make our businesses stronger and more resilient. And that means contingency planning, it means good stewardship, and it means kind of strategic agility in our executive committees to enable this from the top down. Some provoking questions for you to kind of take away is start off the back of this session we're having today. How might the hot topics in the world shock how your business is making assumptions for the next 12 months, 24 months, 36 months? What's happening right now? How might it change? Undertake the thought exercise. How might some of these fundamental trends around climate change, around digitalization, around supply chain fragility, erode your profitability, erode your positioning in the market and your competitive position? How might some of these uncertainties destabilize your ecosystem? So it might not impact you, but how might it impact your suppliers, the utilities that you rely on? Start growing your bubble and understanding how they might be affected. And which ones of your goals is most at risk? So again, that really core focus on a business's goals, which ones are most at risk? Understand that, quantify that as much as you can, so your management team can come together around that. And just to kind of show you if you don't, and this is my final slide, and I look forward to the conversation later, is we've done quite a bit of research on companies who have kind of resilience measures in place. And this is just looking at crisis management, so post an event. And we pulled together effects on share price over time post a crisis. So this aggregated lots of different companies on public listing. And if we start at kind of, the event, day zero, the event that happens becomes public. It might be an extreme weather event. It might be a reputational risk event. It might be a cyber event. But for companies who don't have a crisis management plan in place, we saw a significant drop down in their share price immediately within the first 3 weeks. But then good crisis management, a good response over time is recognized by investors. And that's, something to consider when you're moving in there. In terms of, I see one question on inflation and forex, which I'll just cover off before. And we were speaking about this yesterday as well. I think we've been speaking about this a lot, and my colleague coming in next will speak a lot more on the financial risks as well. The inflation and forex is a massive challenge, but I think it's the immediate, and it's something that has been floating around for a while, and we just need to be prepared for kind of multiple volatile surprises. Thank you. Back over to you, Ned.
Oh, thanks very much. Thanks very much, Dr. Riddell. Hold that thought on the forex risks and interest rates, right? Allow me to introduce our second speaker, Mr. Amit Dalmia, Senior Managing Director in the Corporate Private Equity Group of Blackstone, joining us today to give insights on global investment trends and outlook. Amit Dalmia is Senior Managing Director, Corporate Private Equity of Blackstone. He has been involved in shaping Blackstone's business strategy in India and Asia, execution of new investments, and steering strategic and operational improvements across portfolio companies to enhance business performance and business portfolio director. He leads the value creation agenda for Blackstone at the portfolio company, defining and executing levers of growth operating efficiencies. Defining Blackstone, Mr. Dalmia had diverse business experience of over 13 years with Unilever India in various management and business leadership roles. He has undergone management training program with the Indian Institute of Management, Ahmedabad. Mr. Dalmia received a Bachelor of Commerce honors from St. Xavier's College from the University of Kolkata, India. He's also a chartered accountant, company secretary, and cost accountant with 3 gold medals for securing first ranks in the country. Ladies and gentlemen, let us all welcome our second speaker for today, Mr. Amit Dalmia. Amit, the floor is yours.
Thank you, Ned. Just give me a second. Can you guys see the deck properly?
Yes, we can. Yes, we can, Amit.
Okay, thank you. First of all, good morning, friends. Let me first thank the FINEX Society for giving me this opportunity to present in front of this August gathering. Philippines is special for me for multiple reasons. First of all, when I was posted with Unilever in Singapore between 2003 to 5, I developed a lot of friends, both personally as well as professionally, coming from Philippines. And I must say that without exception, everyone has been so genuine, warm-hearted, and who have valued human relationship more than anything else. So that speaks volume about the culture of the country. And secondly, we have one of the best investments coming from Philippines. So Taskus, which is a business process outsourcing company, has a large setup in the country, and that investment has been just terrific. So we have been truly impressed by what Philippines as a country has to offer. So thank you, guys, for giving me this opportunity. Just to start with a small disclaimer, views expressed here are of my own and does not in any way represent views of Blackstone or anybody else. I thought, given the interest of time, we'll cover 4 areas, and I'll quickly touch base upon them. And if there are things which you want to go deeper into, we can cover in the Q&A section or the panel discussion. I'll briefly talk about Blackstone, give a quick introduction of what we're doing globally as well as in Asia, closer home. Talk a little bit about global investing environment, what we are seeing, how is the private landscape compare and perform in comparison to that. And finally, all of us as the leaders of the companies amidst this global volatile environment, what should we do? How should we react to a situation like this? So let me start with Blackstone. And I've been fortunate to actually been associated with two of the best organizations, which is Unilever and Blackstone. Blackstone is world's largest alternative asset manager with about $941 billion. So very close to $1 trillion in asset under management. It's what we call ourselves as a 35-year-old startup. We are listed in New York Stock Exchange, and our market cap is about $120 billion. We have primarily 4 lines of businesses. To start with private equity, which is our largest business, where we have $280 billion of AUM. So this is the business where we invest in operating companies, work actively with the management, and then grow the business. So that's our bread and butter. Then is the real estate, where we invest in properties across offices, logistics parks, rental housing, hospitality, and all the real estate portfolio. And we have an AUM of about $320 billion. Hedge fund, which is customized investment solution. So that's about $80 billion. And finally, credit business, where we invest in high yield bonds, various forms of financing, etc., which is similar size of about $265 billion. So overall, $1 trillion of AUM. And this is how our performance or growth trajectory has been. And as you would see, in about 25, 27 years, from a $3 billion, we are now reaching close to $1 trillion. We in fact had set out a target of achieving $1 trillion of AUM, which at that point of time looked quite difficult by 2025. But good that we are on track, and hopefully in the next couple of months, we should be able to hit that major milestone. One other thing which I want just to highlight here on this trend, if you see that barring 2008, where because of the global financial crisis, the AUM came down from 102 to $95 billion. In all the other years, you will see consistently AUM has grown from strength to strength. Coming closer home, in India, let me talk about it. Overall, we have about $60 billion of AUM or asset investment across both private equity and real estate businesses. So those are the two businesses primarily we have in India. And in private equity, because people ask what kind of companies do we invest in? So there are 3 investment strategies what we have. One is what we call as control oriented, where we buy control majority. That's primarily the investment model which we work with. Then we have a growth investing, where we invest in high-tech growth companies, which is a strong unit IRR, etc. And there we could buy majority or minority stake. And finally, we have something called TACOps, which is a tactical opportunity fund, where we invest in structured financing or instruments. So those are the 3 types of private equity investment models what we have. And on the real estate, as I mentioned, that we invest in different asset classes within real estate. So overall, in India, we have about 70 companies with almost employment base of about 280,000 people, 100 million square feet of commercial real estate, and about 10 million square feet of retail real estate. And one of the things which is extremely pertinent to note, that globally, now it is well recognized that India and Asia are one of the best performing geography for Blackstone globally. Overall, Indian Sensex, for instance, if it has given a returns of about 10-11%, our returns have been upwards of 35-40%. While it's difficult to sustain that kind of IRR, but it just tells you how lucrative the market is. And the other thing to note is that many of the PE funds actually have a pretty China-dominated fund investment, as performance. But in our case, it's actually the other geographies. So India is a large part of the overall deployment, and similarly other geographies like in Australia, Japan, and Korea, and obviously Southeast Asia. If you move to the next chart, this just shows the types of investments we have done across the globe. Most of our investments are in private companies, so many of us might not necessarily be able to relate. But if I have to talk about some of the hospitality and entertainment industry investments, for example, Hilton, Madame Tussauds, Universal Studio. One of the things which we always take pride in, and if you look at investments like Hilton, we invested before the global financial crisis. And when the GFC hit, the stock price plummeted by more than 70%. And so investment was underwater. And we had to infuse capital actually just from a survival perspective. But we had strong conviction on the business, and therefore we actually infused capital. And as things turned out, it became one of the largest capital gain generator in the private equity industry. So just to give a flavor of how conviction matters, and as a private equity, you could double down on your investment and make disproportionate returns even in the tougher investments. In Asia, if you think about the sectors where we invest, and we have investments across different sectors, like tech and tech-enabled services is large for us. We have companies like Mphasis, IBS Software, Taskers, financial services like Aadhaar or ASK, entertainment companies like, for instance, Crown in Australia, the Crown Resort and casinos. Another theme which we are quite gung-ho and upbeat about is B2B2C companies. So companies which cater to the consumer goods companies like EPL, Piramal Glass, etc. So quite a few of such investments. Broadly, basically, we have invested across multiple sectors in the region and continue to be very positive and upbeat about it. Coming to the global investing environment, and I think all of us have got familiar with the terms like VUCA, which is volatile, uncertain, complex, ambiguous. Recently, I came across a word called BANI, which is brittle, anxious, non-linear, and incomprehensible. So, different people are using different acronyms to define the current environment, but certainly all of us agree that the environment is extremely volatile. And more than just the sheer volatility, the cycle of volatility has shrunk. If you just look at last 3 years, what has happened? COVID hit and entire market seemed crashing down. So world seemed to be coming to an end, stock market, everything came down massively. Then came the massive stimulus. So overall, market reached all-time high. So we started seeing the peak of the cycle. And then came a global coordinated action on reducing interest rates, and the market seemed again crashing down as if there's no tomorrow. So in just over 3 years, to see this cycle of downturn, upswing, and subsequent crashing again is like phenomenal. It's unprecedented. And that, kind of reminds me of the famous quote from Lenin, that there are decades when nothing happens, and there are weeks when decades happen. So what we are seeing is the period where in a very short period of time, we are experiencing ups and downs of a significant scale. And therefore, markets are becoming tougher. There is, and I'll talk a little bit about overall inflation, interest rate environment, and how public market is responding, and overall what we're seeing as on the IPO side. Coming to inflation, and this is a trend which has been hitting every country without fail. US, which used to talk about inflation targeting of 2% and all, is right now has an inflation rate of 8+%, highest ever in the last 40+ years, what the country has experienced. And people initially thought that this is transitory phase and it'll go away, but it turns out to be far more persistent and sticky. And this has made the whole economic environment quite fragile, and countries are experiencing headwinds from an economic growth perspective. Recently, I read a report where global economic growth, which was 5.7% last year, is likely to be less than half of that. So it's expected to be 2.9% this year. And it is likely to remain in this range in the coming years. And there is a risk, what people have started talking about, of stagflation, which is basically stagnant economy, which means lower growth and high inflation. So There are all these terms, etc., which we keep coming across. And if you think about it from a genesis perspective, pandemic had a significant amount of unprecedented historical impact on these variables. You start from an excess central bank liquidity and a massive stimulus package, and you come to the tight labor supply and supply chain disruptions. And each of them had in own way had an impact on this economic impulse. And recently, as Graeme also spoke about the war in Ukraine, how it has caused commodity cost inflation and the supply chain disruption. Another important thing is actually the confluence of mega secular trends, like for instance, China's worsening demographics or deglobalization, and all of them are going to continue to have significant impact as we move forward. So while picture looks quite bleak from an inflation perspective, however, if you look at the recent reports, you'll see that the peak inflation or the inflation seems to have peaked now. There are categories, volatile categories like oil, which seems to be going through correction. Ocean freight for all the exporting countries in Asia, which was experiencing between 5 to 7 times increase the ocean freight rate, the freight rates have corrected significantly, though it continues to be significantly more than the pre-COVID era, but still there's a significant correction which have taken place. So hopefully the inflation might have peaked, but it's sticky and we need to be watchful of that. And in that context, if you look at the market returns, and if we analyze the data for the last 90 years, you will see the left bottom chart where in a era of high inflation, you have a much lesser real returns coming from the stock markets. So S&P 500 average return actually turns negative when the inflation hits 5% or more. So one needs to be watchful of what returns to expect in the current market environment. And at the same time, what is also relevant for us sitting in Asia is the currency depreciation. Like for instance, we have tracked Philippines pesos for quite some time and the currency was quite stable. But in the last 1 year, what we've seen is about 10-12% correction in the currency and weakening of that. And that's across the board. Most of the currencies globally have corrected significantly compared to US dollar. Now, one could argue that in a way it's good for the exporting economies because you become far more competitive. But at the same time, from an investor's perspective, the returns deplete. The returns in dollar terms get affected. So one needs to watchful of how is the currency trending and what's the likely outlook. Even in case of India, in the last 20 years, the average currency depreciation would have been 3%. But this year, the currency has depreciated by more than 7% and continues to be quite soft. We actually recently did a survey with all our CEOs of portfolio companies that in the current environment, how do they see impact on the operating performance? Because fundamentally, that's what matters. How is the business doing? What's the likelihood of business? Because markets could go up and down, but if your business continues to be robust, then you are well placed. And lo and behold, 75% of the companies think that performance is likely to be affected adversely. So we need to be watchful, gear up our companies. So broadly, we spoke enough about inflation, that it continues to be a risk, and globally there is a well-coordinated action to bring the inflation under control. In the beginning of the year, for instance, we know that US had 2 consecutive quarters of GDP decline, and technically that could have classified as recession. However, during that period, 2.7 million jobs were created. The labor participation rate actually improved and corporate profits surged to a record high. So while technically it might have been recession, but in reality, economy had actually become stronger. However, now with the interest rate environment, what we are seeing, there is more and more talk of recession. probability of hitting recession in US and Eurozone is now attached more than 50%. However, I must say that when sitting in India or when I travel in Asia, I see very different environment than compared to what you see in US and Europe. There is far more talk about resilience of the economy continues to do well, etc., and lesser talk of recession than in many of the developed markets. But the fact is, in US, if you look at it, the interest rate, which used to be close to zero, is now 3.5%, and talks are on that it will potentially go to 4.4 to 4.5%. So in a span of less than 2 years, for interest rates to go from 0% to 4.5% is going to have a significant impact on the economy. And this is not just about US. 85% of the world's central banks have actually interest rate, and this is the largest policy action in concert which people would have experienced for a long period of time. And what does it mean? When you have a higher interest rates in US, it makes the asset classes much more attractive and investable, and therefore it might see fund outflow from developing markets or Asian markets back to the US, and therefore it may have a bearing on the stock market performance. So whether recession will hit or not, nobody knows, and hopefully it does not. But the fact is, certainly with the higher interest rates, it'll take air out of the sail, and economic growth is likely to slow down for sure. And in that context, if you look at a stock market performance, and the bottom side of the chart shows how across the country's markets have performed, and you will see that between 15 to 30% markets have corrected this year. NASDAQ, in fact, has corrected by 25+%, and within that, the loss-making or the unprofitable tech companies would have corrected by 75–80%. So massive correction in the public market. And as a result of that, most of the countries are now operating or trading at below their 10-year median. Barring India, which you'll see that actually is trading still at a premium to the 10-year median. Rest all the countries you'll see on this chart is actually trending lower than 10-year median. But the question fundamentally is that how is the 10-year median relevant? Because last 10 years was actually a bull market. So that multiple may or may not necessarily mean anything. And therefore people have started looking at fundamentally longer, much longer term trend and what should these multiples look like. And similarly, what we've seen in the IPO market, where the number of IPOs as well as IPO value has come down significantly. Last year was massive, significant for everybody. Anybody who wanted to sell their stake were looking for a public market listing rather than private market. And therefore, number of deals which we could see was far lesser. But however, with the corrections, what we are seeing, the IPO proceeds are down by 90+% in US and UK. But some of the markets in Asia has done far better. And if you see like India numbers, it compared to $4.7 billion this year has been 5.6. So it continues to be robust. However, there is signs of concerns and slowing down in the IPO market, and it's not as easy. And whenever this market stabilizes, the companies which are likely to receive and go first and receive good public market interest are the companies which are far more resilient, has far better profitability model, and a sustainable business construct. So global market is tough, environment is tough, but within that, if you wear the lens of private equity landscape, and maybe I'll take a second to just describe how does private equity work. In nutshell, first we raise funds from our long-term investors, so which could be sovereign wealth funds like closer to us, GIC, Temasek of Singapore, Abu Dhabi Investment Authority or Qatar National Authority in UAE, or universities, for instance, University of California, Harvard, MIT, and so on, pension funds, hospitals. So we raise funds from our limited partners. Then we look for investment opportunity across the globe. from a country perspective and within the country sectors and specific companies, and then invest in those companies. Then we work very closely with the management teams of those companies to help them grow the business and make them more stronger. And then finally, when over a period of, let's say, 5 to 7 years of investment, subsequently, you look at exiting the business through public market route or selling to other investors. But one of the things which is very pertinent to note is that 2/3 of the capital gains is actually made through the earnings growth. So the fact is, if the fundamental business performance is strong, you are likely to generate significantly higher returns, and that's where focus needs to be there. And for the industry, this number, by the way, is about 50% of the returns come from earnings growth. So private equity, there is a lot of focus on actually making returns through better performance of the operating companies. PE market, again, it has gone through its own ups and downs. And if you step back, overall deployment by the PE and VC industry in a year is close to, last year, actually hit close to $2 trillion. And that was like a 54% increase on YOY basis last year. Out of that 2 trillion, 1.1 trillion is the buyout fund, which is the control buyout investments, which has been quite consistent over years, but this year is likely to be down by almost 30%. So PE market deals have also come down quite considerably. But what's the silver lining there? And if you see the blue stack on the bar, you'll see expanding APAC presence. So which used to be a much smaller percentage of the overall global fund deployment, the deployment has increased significantly, multifold over last 15, 20 years. So APAC continues to be interesting and attractive market. And why will it not be? Because while in terms of overall GDP, our contribution might be less, but in terms of growth, we contribute to more than 2/3 of the global growth coming from APAC region. So it continues to be very interesting, exciting market for the PE industry globally. We've also seen exits last year, as I talked about, that IPOs had really gone up sharply, but this year has seen correction in terms of the quantum of IPO which is taking place. But one thing to note is that PE industry, while the investments and exits might have come down, but there is $3.4 trillion of dry powder, which is sitting with this industry, which is almost 10 times more than what it used to be 15 years back. So significant increase in dry powder, which is waiting for deploying at a good home. And therefore, for good companies, there is no dearth of opportunities. And we talk to our investors, overall, our LPs in general, if you look at the chart on the left-hand side, expect significantly lower performance than what it has been over last few years. And on the right side, you will see the returns over a period of time. While when a crisis hits, people get conservative, and therefore there is an expectation that returns could actually come down. But if you look at 2000 tech bubble, 2008 financial crisis, this actually might be a good vintage. So if you pick up a right company, a right asset, then you might actually generate much better returns than what historically you have been able to do. So what's the broad takeaways? Overall market is volatile. Public market is not looking that great. And therefore, in that context, multiple expansion is unlikely to take place. And therefore, valuation matters. You need to buy the assets at the right price. If you overpay, it's very difficult to make returns on those investments. Secondly, in order to generate returns, you have to focus on operating initiatives, making companies bigger, better, high growth, profitable companies to be able to generate returns. And third is that your hold period could get longer. The liquidity options are going to be far fewer, could be more challenging, and therefore creating some form of exit optionality will be helpful. So for instance, many of our companies, when we look for IPO, IPO is just a beginning of the exit agenda. It may be, you sell a small stake and subsequently over a period of time, you divest your whole stake. So it's much longer period of hold, which might be required. So what should companies do in that context as leaders of our companies? And I think there are two types of approaches one could take. One is the defensive strategy, and second is offensive strategy. And the defensive strategy, the first thing which everybody is talking about is the focus on profitability. If you think about it, just a year back, there were just three things which mattered: growth, growth, and growth. And people used to say that, if the business is growing, profitability will come, and so don't worry about that. But now there is a significant focus on profitability and sustainable business model. So companies which don't have a demonstrated sustainable business model will find it tough to raise fund and to continue to operate business like that. Second, I would say that cash is king. And there is a famous saying that sales is sanity, profit is vanity, but cash is reality. So, focusing on free cash flow yield, etc., is extremely, extremely important. And in the current environment, when you talk about inflation, interest rates going up, etc., it is going to affect the operating performance. I'll give you an example of one of our companies where the company used to make EBITDA of $100 million. And with the cost increase which the company experienced, it had an impact of more than $100 million, which means that entire profit could get wiped out with the cost inflation. So therefore, we had to create a two-pronged strategy. One is to improve the realization through pricing and mix improvement, and secondly, through cost transformation program. So basically, operating initiatives and interventions are must to make sure the companies remain profitable, generates sufficient cash, and remains in good health. The second pillar on defense is the supply continuity and supply security. COVID actually taught us many things about supply chain, which we were not exposed to. The cost was an important pillar, and people used to think about sourcing in Asia, supplying to US and Europe, etc., is the model to go to. But with the supply chain disruption, which the companies started experiencing, people fundamentally started questioning, is this the right model? Should we do near-shoring? Should we be dependent on countries like China, for instance? And therefore, the evolution of China plus one strategy. So making sure that you have a robust, reliable, flexible, agile supply chain is extremely important. And the third most important pillar, which one could argue is a defensive strategy or offensive strategy, but whichever way, is talent. One needs to get the best team to perform well, and nobody can overemphasize the importance of talent. You need to have A+ team members. At Blackstone, we always look for hiring people, whether within Blackstone or in our portfolio companies, people who are smarter than us. People say that, you become like the 5 people you spend most time with. So if you hire best people, then the overall bar or the quality of talent moves up, and as an organization, you stand to gain. And in the last few years, we have seen whole talent market getting transformed. The attrition rates have gone up in our IT companies. We are seeing attrition rates absolutely unprecedented of 30 to 35%. So what has changed? And a friend of mine talked about 4 C's, which is actually accentuating the attrition issues, which is cash. So people have higher expectation on comp, etc. Career, which is different career aspiration. Comfort, people who have been working from home, etc. So there's a different level of comfort people are now seeking. And fourth C is context. So context have changed. People not necessarily work just to earn salary or financial incentive. there are other considerations which have started mattering to people. So these are the 4 C's: cash, career, comfort, context, which is aggravating the attrition and the whole great resignation wave. And in that context, what we talk about the 6 R's to counter that, which is recharging the talent pipeline. So you don't need to look for necessarily the same sources of talent pool. You might have to go to tier 2, tier 3, tier 4 towns, look at succession planning, bench strength, and stuff like that. So recharging the talent pipeline. Remuneration, overall remuneration strategy needs to be relooked at. Role change, give people higher responsibility, bigger, better, give them different exposures. Responding to emerging employee needs. People needs, need more flexibility, more emotional connect. 5th R is reviewing and reframing policies. So the employee policy, like for instance, in India, there's a lot of debate about moonlighting, whether it's right or wrong. But the fact is all these policies, hybrid work environment or work from home working environment, all these policies need to be revisited. And finally, reskilling. And that could be both on the technical side as well as on leadership side. So if you have the right people practice, and I emphasize so much on talent because we strongly believe that it's an important pillar and must address in the current environment. And coming to the offensive strategy, all of us know the importance of technology. You have to be tech disruptor. You cannot be responding to your competition, what they are doing in the market as far as technology is considered. And it's no longer a vertical play, it's a horizontal capability. And what we've seen that the companies in our portfolio, which have been able to disrupt themselves, which have been able to change their business model based on technology, have given multi-bagger returns. And we have enough examples of companies like Sona Comstar, like an auto component company, which became an electric vehicle company and has given 15+X returns. Taskus, for instance, the BPO company, which I spoke about, focuses on high growth new gen companies and has become disrupted in the BPO space. So you have to look at technology, how it could aid your business. Next is to look at the M&A muscle. And when the market is going soft and easy, this may be the best time to actually go look for synergistic acquisition, buy at reasonable value, integrate them well, and create value. So go aggressive on M&A front. And finally on ESG, and Graeme spoke at length about ESG, nobody, whether as an investor, as an operator, can ignore the value which ESG can create, or not focusing on ESG can destroy. So focusing on ESG, making sure that your company is actually adding value to the society and keeping their consideration of all the stakeholders in mind is extremely important. And finally, I'll end the presentation with the thought that you need to focus on creating value. Valuation will follow. We might have turbulent times, ups and downs in the stock market, etc. But if fundamentally business is strong, there is enough and more capital sitting out there to be invested. So we just need to focus on getting the business right. Rest all will follow. Yep. Thank you guys for listening to me, and over to Naim.
Thank you very much. Thank you very much, Amit. You confirmed our worst fears, Amit. I'm glad you did mention that there are steps that you could take, and of course, ending up with creating value, and everything, the rest will follow, right? Now, we would like to move on now to our panel discussion, and we have as a panelist a past president of FINEX and currently the president of BDO Capital and Investment Corporation. He was also elected chairman of the International Association of Financial Executives Institute, EFA, for 2019. Mr. Francisco has worked with other financial institutions in New York and Hong Kong. He holds a master's degree in business administration from the Wharton School of the University of Pennsylvania and a bachelor's degree in business administration from the University of the Philippines. He's also a recipient of the Distinguished Alumnus Award from the UP College of Business Administration. Ladies and gentlemen, Please welcome Mr. Ed Francisco.
Hi, good morning, Ned. Thank you very much. I very much appreciated the talks of Graeme and of course Amit, and I took some notes. Ned, am I allowed to share some of my comments on about
Yes,
their
go.
talk? Yeah,
Yes, please.
No,
Yes.
maybe Ned. Thank you, Ned. I'll just do that. I'll just share my comments because I learned a lot and some of the things really stood out. So maybe I'll just start with Graeme's presentation. And yeah, of course, we're a big believer in insurance, and again, we're being with the bank, we're very vulnerable right now with all these cyber attacks. So I'd love to learn more, Graeme, about insurance available to protect us digitally. But I guess the fact that you talked about the different speeds that are happening, we're so vulnerable. My takeaway was that there's no one silver bullet, as you mentioned, but we have to look at our supply chains. And I learned something new today. Your term we're calling friend shoring. So I guess in the past you were going for the one cheapest outsourcing solution. We were going to China, but because now, and even Amit talked about the problems now of being dependent there, and we're having cost increases, significant cost increases, delays. We have to have friends that can bail us out and have more, I guess, other supplies. And I like the term of restless curiosity to make sure that we're ready. But I guess what I learned, and from my fellow FINEX members, we just have to revisit all our processes and look where we really are vulnerable, because we have to be ready and now we have to be prepared. So those were my takeaways from Graeme's talk, and Graeme would love to learn more about how we protect ourselves or what the insurance is available. If I may be allowed now to share my thoughts on Amit's great presentation also. I liked also the term of how you keep yourself agile, Blackstone. The 35-year-old startup, no? So you have that mentality still. You're still very hungry, and that's why you're very good at what you do. And then also your other new term that I learned, aside from other terms of BANI. So that's something new for me, but I will apply that also in my businesses. But what's very important is, anyway, we talked about the global challenges. I think we're all seeing that anyway. And I really like the charts about comparing inflation and the currency devaluation, because sometimes I guess us Filipinos think, when we think about us reaching 59 and 6, possibly 60, we think how hard hit we are, or we already look at our the valuation in the PSE, how much it's gone down. Your chart showing how we compared, and we're not necessarily even the worst in terms of, let's say, devaluation. I think your chart showed that the UK and the euro have devalued more than the peso. So fellow audience members, it's not as bad. And then even in terms of comparing to the 10-year medians, valuation, yes, it's gone down yesterday. And I was in ANC, but it's gone down to the 2-year low, but still it's not as bad as the rest. But Amit had a very good point. I guess it's good to compare it historically, but also, what we were 10 years ago is very different from where we are going. So we really have to look also where we're going. And his chart on comparing the Philippines and India being the bright spots in the IPO markets, at least it's great that we're both growing, but admittedly the values have gone much lower. But there were so many nice takeaways that Amit presented on where things are going, on what they look at. And it's good for us because for us who wants to raise capital, admittedly, as one of the things he said, there's really a lot of capital there. There's a lot of dry powder ready. But of course, they are more selective on what they're looking at. Even me as a lender on the other side of doing IPOs, we've experienced that. We're postponing the IPOs because it's more challenging. We're seeing also even in the PE market, because we work with a lot of the PE funds, they need a lot more. I guess they have to have a longer waiting period. The horizon is there. It's tougher also for them for their acquisitions, because as debt is becoming more expensive, the project IRRs or the expected returns are lower. So one good thing that that Amit said, which is, I guess, what makes Blackstone and the other great PEs unique, is that if your PE will just come in because of money, then there's really no value add. But if what Amit said is that they come in and you have to have operational intervention, I think you mentioned, Amit, but that's very key. If your investor is coming in with money, but also to get involved in the board to help guide you, not only best practices, but open doors for you, give suggestions on how you can improve profitability, make some changes, then that's really value creation. Because if you really don't create value anyway, then there'll also be no good exit for them, and they won't be able to go out. No? But other than that, so those are the bright spots. But I guess I also like the slides, especially on the offensive and defensive things that we companies can do, because those are very important. So we can learn a lot from it, from being tech disruptors to accelerating change. And I guess M&A is very important. If you can buy at a good price, that's great. And I guess doing it via inorganic growth helps jumpstart the process, because sometimes organic takes so much longer. But there'll always be companies there. And then one of the key things that I guess that also hit me was when Amit talked about talent. Because even I am experiencing that, because the competition is so tough, right? Poaching is happening. And then also, I guess Mignon can share her thoughts later on, because she does a lot of seminars, and then the youth of today are not as, I guess the loyalty is different. Their desires, their goals are different. So they don't stay as long as we the older generation have done. And so the challenge to retain talent, but even more so, the challenge of hiring talent is key. And I like what Amit said about even going to the second and third tiers. We're doing that because the first tiers are really highly coveted already, especially the grads in the first tiers. So the challenge is, how can you find these gems from these carbons, these diamonds in the rough from the second and third tier, who aren't just given the opportunities, but if you give them the opportunities, they're very driven, and they will really shine. So that's really the challenge. So I really picked up a lot from both our great speakers, and I thank you for that. Thank you for inviting me to FINEX also. So maybe Ned, I'll pass the floor back to you, and I'd be welcome to share some more thoughts later. Thank you.
Thanks very much. Thanks very much. Can we invite the other speakers back? Thanks. I see Graeme now, and I see Amit. We have questions. We actually have a lot of questions from the floor. Let me start with questions from Mr. Renato Reyes, as well as from Vic Sars. I think they're a bit related as well. They're asking essentially. Well, Graeme started out mentioning about the tipping point, and I guess this refers to things that are going on in the different economies in the world, particularly on the response of government, fiscal policies, as well as the response of their central banks on their monetary policies. Do you see this as tipping points already, and how does this work moving forward? And I guess that moves on to, for Amit, maybe we can also ask you how it actually works for you in terms of the returns that you're seeing. You did mention that your returns in India have been at the 40% IRR. Is that, did I hear that correctly?
Yes. So, yeah, 30%, I think, Amit, right?
40% IRR for the last 10 years. Yeah. So
40%. So that's Ed, right? Anyway, Graeme, the tipping points.
The tipping points is, and I'll qualify this by being far more of an engineer than an economist, but I think what we've seen is governments not know how. The stimulus that was thrown out during COVID was incredible, and what I think we've seen governments struggle to pull back or figure out how to do it is how to pull it back, and how to take the floor that they built underneath the world's economy and start pulling that back without leading to, you know, the inflationary environment that we were effectively seeing right now. And I think we were speaking about this 12 months ago. in the context of the global risk report of just how challenging pulling this level of support was going to be when people got businesses. We don't actually know the scale of the economic destruction that happened during COVID because the floor was so strong that was put underneath. So I think we're going to see these tipping points fall out as governments just can't borrow as much and can't create that floor and start pulling it back. But that's my highly non-economic perspective on that.
Thanks, Graeme. Amit, I guess the issue and the dangers, there's certainly dangers ahead, right? And has inflation really peaked for that matter? Amit, can we have your views on that?
Yeah, hopefully
oil has gone down, that sort of thing.
Yeah. No, so again, just to qualify, not an economist, so can't comment on what is likely to be, but hopefully it has peaked, and we are starting to see the early signs of slowing down of reducing inflation rates. And the fact is that with the tightening of interest cycle, right, ultimately it will affect the consumer sentiment. And more than talks of recession, etc., I think many of the times I personally feel it's like self-induced recession, right? So you talk more and more recession, then what happens? You say, okay, in the company, I will not invest into a new manufacturing facility. If you don't invest in a new manufacturing facility, which means all the suppliers who are supposed to supply the equipments are not going to get the business. So it kind of creates the so-called vicious cycle that the whole thought converts into action, and those actions lead to the impact which actually you were worried of. So it's just unfortunately that cycle. But the good part is that globally, all the banks, all the countries are actually acting in tandem and recognize that this is a problem which need to be fixed. Now, if you think about the genesis of the problem, right, the stimulus measures which have been given, and we were extremely critical sitting in India that India is not doing enough, because when you were seeing the countries like US pumping in a lot of money into the hands of consumer, you were saying that why is Indian government not doing it? But in hindsight, to at least us now, 2020, it appears that it was the right thing to do, not to put too much of stimulus, which subsequently kind of fuels the inflation and becomes a tougher animal to address. But yeah, hopefully the cycle we are seeing is reversing, and there is a cost inflation coming down, and we are seeing that across our company. So even in fact for talent, the attrition in IT industry, which used to be 35%, has come down to now 20s. So attrition have come down, people switching their jobs have come down, so therefore wage inflation is reducing. So overall, you started seeing a positive movement on that part. However, what's important for all the economies to figure out, how do you avoid recession? Because ultimately, if you don't grow your revenue, it's tougher environment to deal with than possibly just the inflationary environment. So it's a fine balance between the two extremes.
Thank you. You did mention your talent, particularly, I guess, particularly in IT and the BPOs. You did mention an investment in the Philippines. I guess it's related to the question on the floor from Vic Sarsa about what we can do, perhaps, to improve the FDIs into the Philippines, the foreign direct investments into the Philippines. What's this company in the Philippines that you're invested in, Amit?
So Taskus, which is a business process outsourcing company, has a large setup in Philippines.
Okay.
Yeah.
Very good returns and very good returns from this.
Yeah, absolutely. It is a marvelous investment.
And you see the BPO industry continuing.
Absolutely. I think BPO industry, if one has to think about offshoring, Philippines and India are the top two choices which people have.
Okay.
But the fact is that people in general started to talk about nearshoring, etc. But actually, this pandemic helped entire offshoring piece, because if you're working from home and delivering the work, whether you're sitting in US or Philippines or India, doesn't matter, you will deliver the work. So that has kind of given further tailwind to the BPO industry.
Okay, good. Aside from the BPO industries, what other industries are you looking at in the Philippines? I guess going back to Vic Sarsa's question, and how we can improve on the investments.
Yeah, so from our investment strategy perspective, we look at across sectors, and actually it's a exercise we do every year that which are the sectors, what are the tailwinds, what are the thematic bets, etc. we want to invest in. But primarily, if you look at, there are sectors like financial services, B2B2C or manufacturing companies, tech and BPO companies, healthcare, and certain segments of consumer. Those are the kind of our priority sectors. And then there are sectors where we don't invest in, where you don't have necessarily great quality of customers. So wherever the business quality is not as good and robust, we don't look at those sectors or companies in particular. We are not, like for instance, when I spoke about the control-oriented mindset, and as well as the growth investing, some of the company investments which we do, but we don't buy companies, for instance, which has unsustainable business models. So companies which don't have a strong unit economics, etc. And those kind of companies, we don't think we are great investors and can add value to those companies. We invest in sectors which we understand well, where we can add value to the companies, and that's our primary focus. So if we don't understand, we'll not invest.
Good, thank you. Ed, do you have the same thematic focus in so
generally yes, and maybe that's why even on the local side, and maybe Graeme and Amit can help. That's why we also really have almost none, or at least we had one tech stock or even healthcare. We really don't have any listed companies here. Maybe it's also because we're not good at it. We don't have any scientists or engineers, but those are things that we're weak at, but those are something that would be great to develop.
So those could be opportunities in the market moving forward. I guess that's what you're saying, Ed. Okay, let me go back to Graeme regarding, he did mention the orderly transition to net zero, and this will deepen the problems, I guess, economic problems, particularly for developing nations. But are the developed countries actually, from your standpoint, committed to net zero, Graeme?
This is within friends. I think we're seeing a skewed commitment to net zero, and because of the kind of baseline conditions that Europe started with, it's far easier for them to make a commitment to net zero because they're so much closer to beginning with. What we're seeing is, the pressure on coal. We're seeing a great focus on coal and less of a focus on fossil fuels because the US wants oil and gas still. Europe still wants oil and gas. They got rid of coal already. What we're seeing in Southeast Asia is a far heavier dependence on coal. And I think if all of the kind of global pathways towards net zero were developed by academics and scientists, optimized on cost, not optimized on equity. So if the cost of transition to net zero was ever divided by ability to pay or capacity to pay for it, what technologies got retired quickest would look entirely different. You'd be retiring oil and gas in the US far before you'd be retiring coal in the Philippines, if you were to look at the equity angle associated with who has the capacity to decarbonize quickest. So that's the challenge that we're navigating. And I think there is the risk that we're going to make things more expensive to do than not. And when we look at things like from an insurance capacity perspective, insurance capacity for coal is very, very limited. A lot of the insurers and a lot of the reinsurers are pulling out of coal. And now, to be honest, they're pulling out of oil and gas as well. The concept of insurance is to reduce the cost of capital, to make it more efficient, to spread risk. We should be, in my opinion, trying to reduce the cost of capital to retire assets quicker, and making stuff more expensive does not help in that regard. So I think the banks have been more sophisticated in their lending approach towards these types of things and are taking a more pathway perspective. Insurance is more of a binary response. It's been quite on and off. They can pull out of a market next year when they redo their premiums and things like that. versus a 10-year loan or project financing or something like that, which is a far longer lens to apply. Insurance is turn on, turn off. So these are the types of, I think, transition risks that are emerging across Asia. And there was a lot of discussion with Russia and Ukraine about turning coal power plants back on in Europe and things like that. That was going to be done with government backstops and insurance things and all these things that a lot of the independent power producers in Asia don't have access to. They're done by very large utilities in Germany and France with government connections versus an IPP in the Philippines or an IPP in Indonesia or those types of things, which is a single coal power plant or a single generation asset, which is very different. So these are the complexities that I think we need to be better at communicating and talking about. And I think when I look at, the Philippines commitment is contingent on a large amount of international finance supporting the commitment to net zero. And we're having a far lower success of that finance flow, both to enable the transition and also on things like loss and damage. So, who's going to pay for the loss and damage that certain parts of the world have suffered due to emissions that happened in a completely different other place. So these are the risks that I think we're going to have to be more sophisticated in dealing with.
But talking about risk at the micro level, you did mention that there seems to be a difference between what management thinks and what the board actually believe, right? You did mention numbers, 83% of boards.
Yeah, 83% of boards.
How do you make sense of that?
I'm actually not, so I'm partly surprised, but also I think there is the commitment. I think we all know that the commitment exists for ESG. I think we do find it hard to make progress and really defining what progress looks like across the whole gamut of sustainability. So I think the commitment is there and the target setting is there. The actual, if we look at whether emissions are going down, not really. If we look at how many commitments there are, so if we look at how many commitments there are to make emissions go down at a board level or at a country level, yes, we have lots of those. If we look at how emissions are going, they're not going down. And that's, I think, the management reflection on that, is we haven't quite translated that into action yet. A lot of our plans are still 2030 out.
If I can just add to what Graeme said, there are two things which we are doing on this aspect, which I think possibly could help accelerate the actionability. One is, as a firm, we have committed to 15% carbon emission reduction across our portfolio companies within 3 years of investment. So as a program, it is run across our companies. We have a whole ESG team helping our companies figuring out what are the measures to reduce the carbon emission. And second, there is an active discussion and debate about CEO and the CXO compensation linked to ESG strategy and execution of that. So at least a part of that, if that can be done, then you bring in additional tool or a weapon to make it happen.
I think that incentive space, and I work a lot with our colleagues at Mercer. So Mercer are kind of talent consulting and set up teams and those types of things. And the points you were making on talent, I think, were really, really important. And it comes up a lot on net zero as well, of we're making these commitments, but do you actually have the teams to deliver on this? And what does it actually look like? And what skills are you either buying, building, or what skills are you buying or building in your teams to enable some very lofty goals? And I think that the talent piece on the ESG lens is probably underexplored as well, and it's definitely something that we're having a lot. And I speak to a lot of chief sustainability officers, and the first thing they tell me is everything they're doing. And I'm like, great, do you have the people for it? And you can see just kind of, oh, that's
yeah, it's always a challenge, talent right now. Let me go back to some questions on the floor again. they're asking about investments. Well, the thematic investments are tough in the Philippines. Would be tough in the Philippines. But are you considering infrastructure investments in the Philippines, Amit?
Yeah, so infrastructure investments, globally, we are a big investor in infrastructure. We have a separate infrastructure fund as well. I don't look after that particular vertical. However, we have found in Asia, investment in infrastructure not, very attractive. As we have seen that, for instance, currency depreciation is one of the challenge. Ensuring a stable return from infrastructure and in terms of project execution, etc., there are multiple such challenges associated with that. So you don't get compensated enough for those risks and challenges associated with the infrastructure in Asia. So we haven't deployed much capital in that space in the region.
Okay.
But when I talk to our colleagues market, they continue to be very excited about the prospect, but it's just that we haven't been able to get our act right in that space.
And their long gestation project, 40%, right? They're long gestation, they're very long gestation projects, and will probably not hit that 40% average that you mentioned earlier. I mean, so can I just dive into some of the other investments that you're particularly still interested in Asia? That's another question that we have on the floor.
So we spoke about, the sectors which we are, excited about. And overall, just want to highlight is that, earlier we used to deploy out of the global pool of capital. So we used to have one fund from which we deploy across the globe. Now we actually created a separate fund for Asia. So we can deploy both from Asia as well as the global fund. And the Asia capital pool has gone up by 3 times in the last 3 years. So we have a significantly higher dry powder. It shows the interest and excitement level of all the investors to come in this geography. So overall, it's about looking at the country where we want to go double down, sectors, and then within those sectors, the relevant companies and opportunities. So that's how we look at overall investing cycle.
You have all this dry powder, ex-China and Japan, right?
Yes, so China is a small part of our overall investing, dry powder. So it's largely in other markets.
And do you have specific industries in Asia, or you just keep it dry for the meantime?
No, so there are, across each of the market sectors, because the thematic bets could be very different. To somewhere, aging population and therefore investment in healthcare and pharma could be, more important. In other geographies, it could be financialization of savings, and therefore looking at financial services could be more important. So like that, in each of the geography, we will have specific sectors and thematic bets. But as I was saying that in India, for instance, we look at primarily 5 sectors, which is tech and BPO, consumer, healthcare, financial services, and certain subsegments of industrials. So those are the sectors primarily we focus on.
Okay. That is actually for Mr. Sarsa. He was asking that question. Thank you. We have another request from Mr. Reyes. Can you repeat the 5 R's that you mentioned, Amit? Recharging, remuneration, role changing, right? The 5 R's.
6 R's.
The 6 R's.
One is the recharging the talent pipeline. Second is remuneration. Third is role change. Fourth is responding to changing employees' needs. Fifth is reviewing and reframing policies. And sixth is reskilling.
Good. Thank you. Thank you very much. Those are important 6 R's to make sure that you actually have a competent workforce. Ed, do you have any questions regarding, I guess, the market before we close?
Thank you, Ned. Maybe just a last question for Amit in general. Amit, what was interesting as you said that I guess when you're talking about the macro stuff, right? There's a higher chance of recession for the developed versus underdeveloped. So not developed. I agree with that. But then on the other hand, I just wanted to check with you from you guys, the senior guys in Blackstone, the investment committee, recognizing that there's higher chance of recession in the developed markets. Does that mean that you still expect a higher rate of return for your investments for, let's say, Philippines and India, or because we're safer, does it more or less pan out now? How does it change from your bucket perspective?
Very tough question. So we would like the return expectation to come down so that we can
yes, right,
more
yeah,
capital.
right.
But yeah, overall, emerging market has its own set of challenges, and especially the currency depreciation, which I spoke about, right? Who would have imagined that Philippines peso would depreciate by 11% this year, and similarly Indian currency to depreciate by 8-10%, and that just shaves off a large part of the returns which you generate. So overall, I think people in general forget about the developing markets versus developed market, but I think higher quality asset where the risk of downside is much less, the return expectation is lower. So people are ready to invest large capital in a far higher quality companies with lesser expectation of returns. And that applies to all the markets, I would say. But per se, I agree with at least I strongly believe that the developing markets have so much potential to grow that the fear of recession seems distant, while we will be certainly affected by that. So for instance, a lot of our companies which are in exporting space, whether in goods or in services, will certainly have some impact of demand. But if we continue to get our fundamentals right, continue to deliver on our whole premise of better efficiency, lower cost, etc., we will continue to stand benefited possibly, then possibly affected adversely. So,
thank you, Amit. Thank you.
Good. With that, we'd like to thank again our speakers, Graeme, Amit, and of course, Ed. It was indeed a fruitful and knowledgeable discussion. We have learned so much from you. Now, as a way of giving thanks, may we call on our president, Sir Mike Guarin, for the awarding of the certificates of appreciation.
All right. Thank you very much, Ned. That was definitely a very engaging and informative. It's been 2 hours, since we started, so time has definitely gone by very quickly. So if we can start sharing the certificate of appreciations, please. First, with our first speaker, the Financial Executives Institute of the Philippines presents the certificate of appreciation to Dr. Graeme Riddell in recognition of his generosity in sharing his valuable time, knowledge, and insights as a guest speaker, our keynote speaker actually, in the 2022 FINEX Annual Conference with the theme, Is Your Company Ready? Understand Global Investment Opportunities and Risks. Given this 4th day of October 2022 via Zoom and signed by yours truly. Dr. Graeme, we really appreciate your presentation and a lot of excellent insights shared with us. So virtual applause for him. Thank you very much.
Thank
and
you
then
so
for
much,
our
Mike, and thank you, FINEX.
Yes, and we hope to see you soon, no? We'll definitely let you know. And then for our second speaker, again, certificate of appreciation to Mr. Amit Dalmia, Senior Managing Director for Blackstone. We appreciate the definitely all of the acronyms. I'm sure people were writing down, no? 6 R's, 3 C's, among others. So we appreciate the valuable time that you gave us this morning, and for sharing with us very valuable knowledge that we know would be very helpful for us. Again, I'd like to give the certificate of appreciation today, October 4, and signed by yours truly. Thank you very much, Amit.
Thank you. Really honored and pleased to have this conversation.
All right. And then last but not the least, well, the certificate's not showing from my end, but definitely Again, we'd like to give due recognition to our past president and to one of our go-to thought leaders within FINEX, past president and Video Capital President Ed Francisco. Thank you very much for adding, additional flavor to an already robust, and very wide-reaching discussions. Thank you again, President Ed.
Thank you. It was an honor to join Amit and Graeme. Learned a lot.
All right, maraming salamat.
Next to Ned.
All right.
Maraming
Back to you,
salamat.
Ned.
Maraming salamat. Thank you, President Mike, our esteemed speakers, and of course, Past President Ed. To deliver the closing remarks, may I now call on the co-chair of the Professional Development Committee and the President and CEO of Sterling Bank of Asia, Mr. Cecilio Paul San Pedro.
Hey, good morning, everyone. Today, we had the privilege and opportunity to learn directly from Dr. Graeme Riddell about the latest trends and issues concerning the world economy. On the areas that are affected by the global risk perceptions and realities, we have all these takeaways to remember apart from what has been mentioned by past President Ed Francisco. On the economic front, we have to consider the prolonged economic stagnation and slow global growth. On the environmental risk, we are confronted with extreme weather events causing loss of human life, damage to ecosystems, destruction of property at a global scale. On the geopolitical tensions, we should be cognizant of the risks with reference to weapons of mass destruction, deployment of biological, chemical, cyber, and even nuclear weapons, resulting in loss of lives and international crisis. On societal issues like employment, livelihood crisis, pollution-driven harms to human health and severe mental deterioration, and the technological landscape acceleration, where we all need to be focused on cybersecurity and technology governance to maintain public trust. With some of these in mind, we should have the strategic resilience approach to be able to do our part as individuals and as a group in reshaping the world we live in and make it a better place despite the many challenges ahead of us. As for the very interesting talk given by Mr. Amit Dalmia, it has helped us understand thoroughly the global investment opportunities and risks from a company perspective, including the many significant and urgent things that we should focus more on, given the volatilities and liquidity issues that may confront us. Included in his valuable insights are identifying in Southeast Asia investment businesses to take on and what we should be expecting with regard to global investment trends and outlook. He also emphasized that we should have significant focus on sustainable business model with 3 key words in mind: growth, growth, and growth. And of course, that includes, among others, creating value, profitability, cash management, and people management. And so, on behalf of the Professional Development Committee of FINEX, please accept our most profound thanks to our esteemed guest speakers, Graeme and Amit, for graciously accepting our invitation to be part of our session today. We are honored to have you here with us, and thank you too for making time, despite your busy schedules, to share your knowledge and expertise. I would also like to express our gratitude to our past president, Ed Francisco, for being our panelist. Needless to say, thank you very much to our FINEX Secretariat, with Michael Dinluan at the helm, for all their efforts in the preparation and technical support to make this morning session happen. And to all our participants, we have over 200 in attendance. I hope that this morning session will help you improve your knowledge in ensuring that we take an active role in reshaping the future with transformational change. Maraming salamat po at mabuhay ang FINEX.
Thank you very much, Paul San Pedro. We would like to thank, of course, our participants for joining us today, and would like to see you in our succeeding sessions. Of course, this event would not have been possible without the participation and sponsorship of the following: KPMG Manabat and Company, Union Bank, MegaWorld, CDO, Foodsphere, NOAA Business Applications, Vista Land, All Home, Ayala Land, Deloitte, the Institute of Management Accountants, Philippine Shell Petroleum Corporation, Robinson's Land Corporation, Smart Communications, SGV, BDO, FTI Consulting, PNA Grant Thornton, San Miguel Corporation, RCBC, St. Peter Life, McDonald's, and Wilcon Depot. Thank you again, and that ends our program for this morning. Goodbye and keep safe.
Thank you, Ned. Thank you, Ned. Thank you, Mike V, Jeff, Rafi, Alex, Marga.